Investors wondering what to do with their money now. It's been a great year for the S&P, up 18%. You take profits, you sit out political uncertainty, or stick with what's working. Dan Suzuki is Deputy Chief Investment Officer at Richard Bernstein Advisors, and Chris Senek is Chief Investment Strategist at Wolfe Research. Welcome to both of you. Chris, just real quick off the bat, do you have any data or kind of, charts that would tell you, kind of point you to where you'd want to be, or do you do anything right now, or do you just kind of sit and wait?
Hi, Kelly. Thanks for having me on. No, I don't think you sit and wait. I think the train's left the station, right? Investors have been structurally underweight financials and energy and some other earlier cyclical areas of the economy, not knowing at the end of the day if it's truly a late cycle or early cycle environment, because there's very much been mixed signals. And now I think markets are coming to the conclusion, even for the event over the weekend, that the Fed's likely to cut sometime this fall, whether it's September, November, or base case is September. And you potentially have the possibility of Trump winning the presidency and the GOP controlling Congress, which would probably lead to a more pro-growth and bigger fiscal package next year. So the positioning that we've seen, the moves we've seen in positioning in the last 4 to 5 days, I think have a lot of room to run, namely financials and traditional energy. I think these trends can continue because the stocks in those sectors are still very much cheap relative to the Mag 7.
It kind of bolsters, Dan, the rotation that appears to be maybe gingerly starting to take place. So Chris said maybe financials, maybe energy are places you look. But he also said the train has left the station. And again, nothing's ever certain. I mean, is there something to be said for waiting a few months or kind of just, wait till November or even to just say, is it such a sure thing to go with financials and energy, even under the fundamentals that you think would be supportive in a Trump presidency?
Yeah, Kelly, it's a really good question. I think ultimately there's no need to wait for an election. I don't think that whether it's the election or the Fed, I don't think those are actually going to be the swing factors. If you're going to wait for anything, I think you wait to see what earnings are looking like, because ultimately that's going to be the critical factor here. We're just kicking off earnings season. And a lot of these stories that have been cheap and left for dead are really show me stories at this point. They've actually disappointed. Their earnings they have disappointed relative expectations. But this is really a critical period where you should see that broadening out and big acceleration in earnings across the board here. So I think if you're going to wait for anything, I think that's what you wait for. But really, I don't think you need to wait. I think the signs are clear. You want to basically own the companies that are going to drive that earnings acceleration here.
So if that's the case, earnings acceleration is the only story, Dan, then really that takes us back to the Mag 7, doesn't it? I mean, maybe the Fab 5, but that's where we've seen 80% earnings growth, right? Isn't that where you'd go, or do you think we get earnings acceleration in the financials and in energy?
Well, Kelly, that's where I think you draw the distinction between levels and rate of change and direction here. Because certainly, those large companies have the best earnings growth, and it's really phenomenal. But if you talk about acceleration, their growth numbers are actually decelerating here. And so if you really do want to own the sources of acceleration that have been left for dead, it's really in those traditional cheap cyclical areas of the economy that you see in the rotation into both this week and last week.
Yeah. I don't know, Chris. So where does that leave you? I mean, do you want to make any big calls on the dollar, right? In this kind of environment on bonds, on inflation? I mean, I thought that actually Michael Darden made a good point over the weekend. He said, look, even as Trump's reelection odds have gone up, inflation break-evens have not. It's not as if the 5-year or the 5-year forwards that those are kind of breaking out to the upside. They're not. The market doesn't necessarily seem to think his presidency would be inflationary.
Yeah, my view is that if there was a Trump win, and what we call a GOP trifecta, the 10-year hits 5% by the end of this year. If you look at what happened in 2016, or even the blue wave in 2020, bond yields along end shot up. And my guess is the physical package that gets passed next year, should Trump win, will be larger than a lot of market pundits are expecting right now. So I think it's a bit of delayed effect. The bond market's sending a lot of mixed signals right now with respect to rates and break-evens. And I think short-term break-evens, Kelly, are always driven by the change in oil prices, is my view with them.
So that would be the more important factor anyway. All right. Nevertheless, gentlemen, we'll leave it there. Appreciate it.